Anyway, pricing rates into premium.
Rolling in the deep is the one that you're probably.
I don't think so.
Thinking.
Anyway, Tony made a mistake before. That's how we got in.
Tony made a mistake before.
That's how we went down this. That's how we went down this rabbit hole. He told you we were doing a piece on zero DT, but we're not. It's coming. That is coming, I think, in the next day or so. This piece today, we're talking about.
And when you confirmed we were doing it, that wasn't a mistake?
No. This one we're doing is pricing rates into premium, because we got a lot of questions yesterday. We get a lot of questions every day, but we got a lot of questions yesterday about what is a Fed move?
What does the fox say?
What does the Fed move really do to option prices, and how does that change the way we trade or anything else? So we decided to take a look. So with the annualized overnight financing rate sitting at roughly 4.5%, we want to discuss how the rapid rise in short-term rates has affected both puts and calls. Do you think it's affected both puts and calls?
Now that interest rates have risen?
Yes, to 4.5% from zero. Do you think that has affected both puts and calls? And then
in our time frame of 45 days, probably not.
And that's the first part of the question. He says probably not. The second part is there a tangible difference in how we will trade based on the rise in rates?
I would say zero.
Okay. That's the BAT's answers. Zero and not. Let's take a look. So
seriously, you are amazing.
It's about damn time.
You're not sleeping, are you? Is that the problem?
No, I slept like a baby.
Did you?
Yeah.
A baby? Where are you from now? Ottawa?
SPX options we looked at. We don't usually use SPX options, but it was easier to do study using SPX. So we observed put and calls equidistant from at the money, and we looked at the March 17th cycle. That's the regular expiration that we all trade. That's the normal quarterly expiration. That's triple witching. So this allows us to accurately price out the interest rate premium and compare the same strike. So what we did is we looked at the money strike, the $100 out of the money, and then the $200 out of the money, which is, if you were doing like SPY, it'd be $10 and $20, okay? And we compared the current spot prices to the theoretically equivalent SPX prices with the same strike. So we looked at IV, duration, and skew, but set the interest rate component to zero. It's a little bit complicated, but again, let me read this. We compared the current spot prices to the theoretically equivalent SPX prices with the same strike, same IV, same duration, same skew, but we set the interest rate component to zero. So we compared this. We compared all that stuff. Let's go to the next slide. So for current at the money options, the calls were actually much more expensive than the puts. And as you go further out of the money, the puts get richer due to the downside skew premium. On the next slide, we'll remove the interest rate premium while keeping everything else theoretically the same. So this is the current prices, okay? So the at the money calls, SPX options, current prices. At the money calls are a little more expensive than the at the money put, but $100 away, the puts are more expensive than the call, and then $200 away, the puts are a lot more expensive than the call. And that has to only do with, that's put skew, right? Mm-hmm. Okay, that's where the market perceives the velocity of risk to be. On a short-term basis to the upside, on a short-term move to the upside, on a longer-term move to the downside. Let's go to the next slide. So if the rates were to go to zero, the following change in premium would occur. This is pretty interesting just because it's across the board. It's worth noting that the skew component is irrelevant when looking at interest rate changes because the premium from rates is determined solely on how far the option is from the at the money. So what we're saying here is that the SPX options, if rates went to zero, would be the calls would be $8, $5, and $3.50 lower, and the puts would be $8.50 higher, $5.50 higher, and $3.50 lower. So what you've seen because of this rise in rates is the calls go way up in price from where they used to be. You remember how the puts were like 2 times the calls? Well, that's why. Because but now it's changed because of the higher interest rates. The puts, the calls have gone up in price relative to the puts. So the puts have gone essentially down in price and the calls have gone up in price as interest rates have gone higher.
De minimis.
It's not really. I mean, you know, it's a $17 swing at the money.
That's true. That's true.
Yeah. So let's go to the next slide.
Equal on each side. So the price is the same.
Yes. So all this to say, however, is that this interest rate premium is a financing adjustment and it's not tradable. That's the important thing. It's not tradable. So the rate premium is similar to how index futures are priced higher than the spot indexes due to the cost of capital adjustment, and that's added on to the spot price. Because remember, when in the futures market, everything's built in, the dividends and the cost to carry. So you don't have to figure any of that stuff out yourself, and you get the inexpensive cost to carry rates. But what we're looking at here is a market adjustment that can be thought of like carry costs in futures or dividends in individual stocks. And that's really all it is. It's just a change in the cost to carry. Let's go to the last slide. So for takeaways, we say the increase in short-term rates has caused a financing premium to be added to the calls and to be discounted from the puts. The effect that rising rates have on our trading, however, is irrelevant, and we would not trade any different. Think of this like a scheduled dividend that adjusts to the prices of the options to account for it. That's a really good way of explaining it. Because does it change the way we trade? Not at all. Right. But it has changed the prices and the relationship to those prices and skew. Like they just look different. You know, if you had
just not actionable.
Yeah, if you had looked at the SPX a year and a half ago, can you go back to slide 3, John or Beth? Yeah. This slide. No, one before. So if you had looked at this a year ago or a year and a half ago, those puts would be $8.50 higher. So the puts would be at 90, basically, let's call it 95-ish. And the calls would be at 90. So the at the money would be completely, it would be inverted. It would go the other way. It would be the inverse of what you're seeing now.
Sure.
And that would look completely normal. Like if you said to me, what does normal look like? It doesn't look like this to me. Like I'm not even used to those prices.
Sure.
But what the marketplace is doing is they're building the higher carry costs. Because if you were to buy a basket of stocks now, you would pay a lot more to carry that basket. It's not the price of the stocks. It's the carrying cost that's built into that future. To borrow
the money, sure.
To borrow the money. Here, here's
this is a market maker model that you're looking at here on how you change the prices of the options when you're looking at cost to carry. That's why I said the shorter dated options have a lot less movement to them and change than the further longer dated options. I mean, the leaps and everything will be a lot more affected by this. Go ahead. I'm sorry.
Yeah, but another way to think of this, which to me is interesting, is so when interest rates were zero, the cost to carry was very low, and the dividends were the dividends were high. Let's say they were 2.5%.
They were higher than zero.
Right. So you're collecting a 2.5% dividend, and you're paying virtually nothing to carry the stock. Right. Mm-hmm. That was when interest rates were super low.
So you would do that all day long if you could capture that 2.5% spread.
You can't really capture it.
I understand that's the point. That's how they price the options effectively. Right?
But that's how the futures are priced. Then what happens now is the interest rates are higher, 4.5%, and the dividends stay the same at, let's say, 2.5%. So now it costs a lot more to carry it, and so it's built into the option prices. It doesn't
You'd have to
change.
do, otherwise there would be an arb there for sure.
It doesn't change the way we trade at all. It just explains the difference in the pricing skew from what it used to look like to what it looks like today. The out of the money puts still have the velocity of risk priced in, but it's very different and much less than it used to be.
Very good, sir. Well done. Well done by the team. The team is looking for confirmation from you.
Harumph.
Are we good?
Of course.
Let's take a quick 90-second break. Come back. We got, oh joy, Mr. Scott Sheridan coming to the house. Tastyworks World Headquarters.